Okay. So yesterday we have finalized the expansion project type. We gave the example and we tried to do it on Excel. We did it. Now, what we had it here, we created the annual cash flows projections where we did the sales of OPEX, depreciation, and we tried different method of depreciation using the straight line method, using the macros for 3 years, 5 years, where we had the remaining book value balance. That's what we had it. And then we calculate the terminal value of non-operational cash flow too. And then we calculated the NPV and IRR. And another type, let me just share it. Another type of the project that we need to go with is replacement project analysis. So replacement project analysis will take the place when the firm decided to go and replace the existing project or existing equipment because it's old, because it doesn't provide the efficiency in terms of the cost, in terms of the boosting the sales. So there are many, many reasons that could stay behind this, but the company has decided to change it. So with a new and better equipment. So when there is a replacement decision, the relevant cash flows expand to consider this position of replaced asset. First of all, incremental depreciation expense, where you compare the old with the new ones, like you have old depreciation that already estimated and the new depreciation with the purchase of the new assets. And incremental cash flows, where you do compare the old sales, old costs, old OPEX with the new ones. And then you get these differences and you just apply your analysis. So basically, the idea about the replacement project is more or less the same with expansion project. There are 3 steps. You need to calculate the initial outlay, you need to calculate cash flows, and you need to calculate terminal value of non-operational cash flow. And then, of course, you're going to be estimating NPV. To estimate the initial outlay, here I would like you to pay attention and try to listen very carefully. It's very important. It's a bit challenging part in here to construct the initial outlay for the replacement. It consists of following: fixed capital investment, like you bought the new item and you're investing. Okay, how much money you spend on that? Net working capital. So up to this moment, it is same as it was in the expansion project. Then we introduce a sale of the old equipment, because you're gonna replace the new one with the old. You're not gonna throw away that old equipment. You need to make some money from that. You're gonna sell it in the market, but you're gonna sell it with the market price, whatever the booking value will be there. Okay. Example I will give you now. Then of course you have to pay the tax on that. Okay. You sell it, you make some profit on that, you pay the tax. But the profit will be there if your sale value will be more than the book value of the old equipment, as it was the last time we did it. Example I will give you now. Imagine you have 1, 2, 3, 4, 5, and 6 years. Okay, life of the project. Okay. And in the 3rd year, let's say the price of the asset you purchase, it's like 100, 120, make it more, 1,000. And it's depreciated straight line to 0, means like every year depreciation value will be by 20,000. Yeah. This is for old equipment. And this is, I'm gonna put it like, it's a depreciation. Now, let's say at the end of the third year, you have decided it's better to replace this equipment because new technologies came, new softwares, or maybe something, new features with the equipment, and you want to replace it with the old. Okay, at the end of the third year. So 4th and 5th, 6th year, you will use it for the new equipment. Okay, this is cost of old equipment. And the new equipment, new cost of equipment is, let's say, 200,000. But this 200,000 will be incurred at the end of the third year, not the beginning of today's project. Okay. So buying this project, to start this project, we spent 120,000. Okay. And depreciation of new will start from this year. Maybe straight line again, okay? I don't know. And you're gonna be using just for 3 years. You can depreciate in 3 years, but you can depreciate in 6 years and so on. Let's depreciate in 3 years, just to be on safe side. Like make it 3 years. Dividing it by 3. Because my project will last remaining 3 years. So like this. This is new. Okay. The idea is that at the end of the third year, you will replace this project equipment with the new equipment. So the old equipment will deteriorate by 20,000 each year. In total, accumulated depreciation will be 60,000. How much remaining? 60,000. Let's imagine you decided to sell old equipment for 50,000. Okay. And of course, we forgot to mention net working capital, which is 35,000. And you sell old equipment for 50,000. Now you're asked to calculate initial outlay. First, you have to include fixed capital investment in new equipment plus net working capital minus old sale. Why minus? What does the logic state? Why we just put here minus when we sell it? The old equipment.
Was the selling price or the cost?
No, there's another reason. What are we calculating here? Is it income or cost? It's a cost, yeah? And when you sell it, is it income or cost? Income. So when there is a cost and there is an income. So the income should be taken out from the cost because the money comes in and money goes out. There should be difference. And of course, plus tax on sale minus book value. Let me make it bigger. So I know what is my fixed capital investment. I know what is the net working capital. I know for how much I'm gonna sell it. Let's say the taxes is 35%. And I know my book value too. So my fixed capital investment is this plus net working capital minus the amount that we are selling it for plus the taxes multiplied by difference between the sale and the sale of the old equipment and the book value of the old equipment. Sale is this one minus how much? 60,000 because the remaining balance of all the equipment in terms of the book value is 60,000. How do I know it's a 60,000? It's just remaining years of the project, okay? So this will be my so this is my fixed capital investment, 200,000. So this is my 200,000. That goes to here. Fixed capital investment. This is my net working capital. Goes to here. This is the sale price that comes here. This is the tax rate. And I have my sale price again. And this is the book value, the summation of these three values for the remaining 3 years. So the real value of my asset that I'm selling is 60,000, but I'm selling it for 50. So do I make any profit in here? No, it's a loss. So that means I won't be able to make any profit, and the government it's not going to charge any taxes on me. Instead, they will provide me a subsidy. Is that clear? Are you all with me, guys? Today we're gonna have the activity like at the end of the class. So just for your information. Any questions? So this is how we calculate initial cost of replacement project. Is the logic clear? Do you want me to clarify it again? Do you want me to just show it again, the explanation? Yes or no? Okay. Now, again, coming back to this formula. I will copy it and paste it here. Now, my fixed capital investment. First of all, initial outlay, it shows you that how much money you're going to be spending when you decided to replace your project. The first amount of the money that you will spend is basically the purchase of the new equipment, which is this one. And then you have to include the net working capital too, like how much money you will need to put into daily operations, which is the net working capital, which is this. And of course, you have the old equipment to replace by new equipment. You're not going to throw it away, you're going to sell it. And you decided to sell it for 50,000, which is this. And we subtracted 50,000. And then whenever you sell something, you have to pay tax on that if the selling price is more than the book value. Book value is the original price that you recorded when you purchased that item. The first day, I purchased today, and whatever is remaining in balance. This is the book value, okay? And I can see that my 60,000 already deteriorated, used, I'm putting it away, and the remaining is 60,000. So I'm going to be using it here as a book value. So this is my remaining. And this is my selling price again. 50,000. And the taxes is this 35,000. 35%. Is that clear? Yes. No, before it's done, it's gone already. It's already, we lost that value. Whatever is left, we will be dealing with that. 60,000. Which one? 66. It's just number of the years remaining. Like I bought the new equipment, I decided to depreciate it in 3 years. And I just divide it, it's a straight line method depreciation. You divide it by number of 3. If the project gonna last with the new equipment 5 years, then you're gonna divide by 5. If it's 10, you divide by 10. If it's straight line, it could be the macros too. It could be any other depreciation method.
But the logic is still the same, we're
Yeah.
just like summing the remaining.
Yeah. Okay, let's move on. Then there's it. Guys, those who are online, if you have any question, don't message, just raise your voice there, okay? Unmute your microphone and ask like this. Okay, now, that's what we do. The second, we just calculate the differences of sales, cost, and everything. Like new minus old, new minus old. That will give us, and this terminal non-operational cash flow value, it's the similar. You get the salvage value of the new minus salvage value of old plus net working capital minus tax, salvage value of new minus the book value new, salvage value of old minus the book value of old. Okay, let's go with the example here with the replacement. Suppose the Michael would like to replace the existing printer with a new high-speed copier. The existing printer was purchased 10 years ago at cost of $15. Okay. Now, the cost of existing printer or cost of old printer is how much? 15,000. Then the existing printer was purchased 10 years ago at a cost of, okay, the printer is being depreciated using the straight line basis, assuming the useful life 15 years. So the project gonna last for 15 years, but 10 years already passed. Okay. Life of old project is 15 years. Okay, but 10 years passed, yeah? That's what we know it. Remaining life is 5 years. Okay. The new and the salvage, okay, if existing print is not replaced, it will have the zero market value at the end of the useful life. Okay. The new high-speed copier can be purchased for 24,000. Okay. Cost of new printer or copier is 24,000, including both freight and installation. Over its life, 5 years, it will reduce the labor and the raw materials usage sufficiently to cut annual operating costs from 14,000 to 8,000. So we can see that the reason why they have decided to replace it is to reduce the operating cost from 14 to 8,000. So we know that OpEx alt is 14,000, yeah, that's what we know it. And OpEx new is 8,000, not bad. What else we are given? And life of the new project. Life of new is 5. Okay. It will reduce the labor raw materials. Okay. It is estimated that the new copier can be sold for 4,000 at the end of the 5th year. Okay. Which is the salvage value. Salvage value new is 4,000. And the old printer's current market value is 2,000. So currently, sale old, yeah, is how much? 2,000. This is for how much we can sell it, the old. Okay, we go further, but we're gonna be selling it at the end of the 10th year. Okay, that's what you should take it into account. If the new copier is acquired, the old printer will be sold to another company. That's the condition. So we'll sell it. And the company's marginal federal tax rate is 40%. So I put the tax here too. Tax is 40%. And the replacement copier is slightly below the average risk, so the net working capital requirements will also increase. So we have net working capital too. Net working capital, 3,000. Okay. And by IRS ruling, the new copier falls into 3-year MACRS class. Okay, we need to calculate MACRS. MACRS, 3 years. Okay, the project cost of capital, I mean the return, okay, discount rate is 11.5. And compute the initial outlay, OpEx over the project's life, the terminal cash flows, the micro replacement process. So determine whether the project should be accepted using the NPV analysis. Or in other way, determine whether the project should be replaced. Whether we should replace or not. If you don't know the techniques, you don't know how to estimate the feasibility, you would have come with the idea that I would replace because I'm saving it, yeah? Because my cost was 14, now I'm like paying less. But we are not given any details about the sales. And we assume that the sales don't change. So when we replace the old with the new, we assume that project will be generating same number of the sales without any change. So we can put a 0, we can put 100, whatever, okay? So what I do here, we have grabbed all the details, data parameter is constructed, okay? The important part of the cash flow projection is to gather the data and put it correctly. Otherwise, so we have old sales, OpEx, and depreciation. And we have new, again, there's 3. But for 5 years, yeah? My sales, which is not given, I put 0 for all years. You can put 100, whatever, but the sales for both should be same. old and new, because they are not given. They are assumed that they don't change. They are fixed, okay? Regardless of. Now, OPEX, old one was 14,000, yeah? And new one, it's 8,000. That's what we know. For 5 years. And depreciation, it was 15 years for the old one, straight line method. So each year it was 1,000. But 10 years already passed for the old equipment. For the old equipment, 5 years remaining. And for the new one, we need to follow 3 years MACR. Okay, we need to check the MACR's table. So I go here and check the MACRs. Here we go. Okay. There's the MACR table. Okay. 3 years is here. 33, 45, 14, and 0.74. So I'm gonna put here 0.33, 0.44 and 5, 0.14 and 8, and 0.074. If I'm not mistaken, they should be in total 100. Yeah, 1. Perfect. Here we go. Yeah. So this is the MACR's percentage that I'm gonna be using. As you noticed, it does not depreciate. The depreciation is not like spread over the life of the project. It's spread only within the 4 years. Like 1 year will be without depreciation. It's possible still. Even you can like depreciate your item within 2 years, the remaining 3 years will be without depreciation. So it means that my new equipment depreciation is how much? Should use it like 24,000, yeah? Multiplied by corresponding rate. So that will give me the depreciation based on the MACRs. Okay.
Sorry, Professor, could you show the formula again? Thank you.
You're welcome. Okay. Now we are almost done. Do you have any question up to this moment? Okay. Now we need to calculate initial outlay. Okay. Initial outlay. Let's do it. So initial outlay, using that formula that I was saying, it's basically for how much you're gonna buy the new equipment, it's 24,000 plus net working capital, which is 3,000, minus the sale of the old equipment. For how much we're gonna sell the old equipment? 2,000 plus the tax 40% multiplied by sale of the old equipment minus remaining book value. And the remaining book value is how much for old equipment? Book value, it's a value of the depreciation remaining. It was 15 years, 10 years passed. And after 10 years, we are selling it. 5,000. 5,000. Again, it's a summation of the remaining balance of depreciation. Okay? Is that clear? Are we all on the same page? Which calculations you want me to show? This one? Do you want me to
Yes,
explain it again? Okay, I will delete it and again. I'm using the formula which is here, guys. This one. I'll copy it and I'll paste it here so that you can see it. Okay, now, first of all, I need to use the fixed capital investment, means how much money you spend to buy the new equipment, new printer. Yeah? How much? Tell me. 24,000. Then net working capital, which is this, minus sale of the old equipment. For how much I'm selling it? No, selling 2,000. Yeah? So this is sale. Then plus the taxes, 40% of sale. Yeah? I'm selling it for 2,000. I have to pay tax on that. If I assume the book value is 0. But what does the book value mean, guys? I think the problem in here, you don't understand the book value here. What does the book value refer here?
The remaining.
Let me give you an example with the mobile phone. My mobile is here. I'm gonna sell it for 2,000. But the real value of this book mobile is 5,000. Am I making loss or profit? I should sell it at least for 5, not to make a loss. But the market says, look, you won't be able to sell it for 5, you can sell it only for 2. But my value of remaining of this mobile is 5,000. Same thing with the equipment, same thing with the printer. The printer depreciated already for 10 years and 5 years remaining. Depreciation for each year is 1,000. 5 years remaining means 5,000 the value of your printer. You're expecting that you can sell it at least for 5,000, but the market price at that time is 2,000. Means that you are making loss of 3,000. So you don't pay any taxes, but instead the government gives you return, a subsidy. Am I clear? The backside is silent. Either you understood everything or shying to ask. Please, if there is something that you need to clarify it again. I can do it. Because this is very important, guys. If you don't understand these things, then later everything will be depending whatever we cover now. Okay, I think everything's clear. Now, then I subtract the book value of 5,000 from the sale price. Okay, this is my initial outlay. Now I need to calculate the cash flows, like sales, EBT, tax, OCF after tax. Again, I'm adding the depreciation back, terminal, non-operational OCF, and total OCF. Yeah, sure, I will. Again. So this one is this.
No, this last part, why it's -5,000.
5,000 is the remaining balance. Here. So we have 5 years remaining, guys. Yeah, this is 5,000. This is the 5,000, I mean. It's given. It tells you that the all project is 15 years. 10 years passed, 5 years remaining. That means the value of your old equipment is 5,000. But you're selling it for 2,000. Means that you're making a loss. It's here. Here it says 15 years and no salvage value. If existing printer is not replaced, the depreciation annual during the 15 years will be 1,000. So 10 years passed, 5 years remaining. The book value, 1,000. Yeah. Are we all done? Okay, let's move on. So sales, basically, how are you gonna, and this is the, by the way, it's just, let me just call it incremental analysis. This is how we call it. Incremental analysis. Now, my sales for incremental analysis, it's basically new minus old. New sales minus old sales. My new sales is 0 and old sales is 0 minus 0. Yeah.
So we're counting only the first year.
Yeah, no, we'll count every year.
Oh.
Every year. And you pull it to the right. And OPEX, new minus old. New minus old. That's the logic. And depreciation is the same. New minus old. New minus old. By the way, pay attention to the OPEX. It became negative here. Negative sign in OPEX, in cost, in specifically in Excel, means that you're saving. Because it was 14,000, now it became 8,000. You're saving 6,000. And now you can calculate earnings before tax from it. How do we calculate? Sales minus OPEX minus depreciation. That's it. And you pull it to the right. Let me show it to you. So calculating the sales, it's a new minus old. Calculating the OPEX and depreciation is the same. New minus old. New minus old. And then to calculate the EBIT or EBIT, you need to subtract from sales the OPEX and depreciation. Any question?
Always, will subtract all from the one,
Sorry?
will subtract Old from one,
No, new minus old.
new minus one. Is it a minus?
Yeah, it's a minus, it's a negative sign. We always subtract new minus old. Just remember it.
Minus, just one bracket.
It's automatically, in my case, it could be just minus in your case. But this number should be negative now in here. New minus old. That's the rule. And taxes is 40%. OCP after tax, it's basically this minus this. And depreciation, we put the same.
Very complicated, taxes.
Tax is just 40% of the EBT. It's just 40% of it. Just 40% multiplied by 992.
If the earnings is negative, we still pay tax.
No, you don't pay the taxes if you see the number reduces. Or if you after tax, it becomes lower, your negative. It becomes closer to zero. Because as I said, if you don't earn anything, you receive the tax subsidy. In reality, it works like this, guys. In Kazakhstan, everywhere. Like, no matter whatever you are, if this year you incurred a loss, next year this will be reimbursed. When you will be paying the taxes, the loss of this year will be reimbursed in the next year. This is how they work and apply in here. And the tax amount, again, let me remind you that whatever you estimate is not matching with the estimation of the government. Always there is a discrepancy. This is another issue. Okay, terminal non-operational cash flow. That's another challenge. Okay, it's another issue that we need to worry about. Like, it's really a bit critical. Again, I'm gonna bring the formula here of this terminal non-operational cash flow. So salvage of the new minus salvage of the old. I will copy it and paste it here. Now, let me calculate. First of all, salvage new. Are we given any salvage new? Here. For how much we're gonna sell it? 4,000, yeah? Is there any salvage of old? No. It says directly there is no salvage value for the old. It says here. If the existing printer is not replaced, it will have zero market value at the end of its useful life and no salvage value for the old equipment. Okay? So I will put here like salvage value of old. I'll put 0. Okay. Now, open the bracket, 4,000 minus 0, yeah? Like this. I'm just applying this formula, guys. This formula. New minus old. Plus net working capital. Are you all with me, guys? Then I put the tax minus the tax, 40% multiplied. New salvage value minus the book value of new. Book value of the new, is there something remaining? At the last year? No, nothing. So I will put 4,000 minus 0, yeah? 4,000 minus 0. And minus salvage value of old minus salvage value of the book value of old. But we don't have the salvage value of old. If in case you had it, then you can put it. But in this case, we don't have it. Again, I'm going to put the formula saying that 0 minus 0, like this. Okay?
Is it book old 5,000?
No. Book value
Of the old,
at the end of the period.
at the end of the 15 years.
Yeah. Because we are estimating terminal value. If you didn't replace the old equipment, what would be the book value of the old equipment at the end of the 15th year? 0. Because we are estimating the terminal value of non-operational cash flow for the 15th year, for the last 5th year. Okay? I don't know, let me check whether did we correctly calculate. This is correct. Correct. And terminal value. Yeah, correct, yeah. Okay. Now, we're almost done, guys. We're almost done. We're almost done. Now we need to just summarize it, add this all, pull it to the right. And our investment cost is here. Okay. And I can calculate my NPV. I'm just adding up, okay? I'm just adding this up. This two should be added. We are adding the depreciation back to OCF after tax. Because it's a non-cash item, it was deducted or subtracted for the purpose to estimate the tax amount. So my NPV with the discount rate. I'm coming, yes. Yes, we should. We should. Thank you. Thank you. We should do that definitely. Last investment cost. And it has been mentioned that we should add the last year terminal value too. Why would then we calculate it if we don't add it? It's a cash inflow, but not from operations. Okay, we added the net working capital, perfect. And as you can see, our NPV negative. What does it mean? Would you replace this project?
No, because that is
Negative, yeah. But if you didn't know these techniques, how to evaluate the project, you would have said maybe like we should because it saves the cost. from 14,000 to 6,000 to 8,000. But still, it's not enough to go with this project.
Sorry, Professor,
So
could
we
you
would
please
not replace it. So
show the
sometimes when you
formula?
see the things from the first vision, it may look like it's good to replace. However, when you go to analysis, you see that it is not. Let's do the IRR.
Sorry, Professor, could you show the NPV formula?
IRR. %9. And our discount rate is 11.5. So the rule for the IRR, in order to accept the project, the IRR should be greater than the discount rate. But the IRR supports as the NPV. We should not invest or we should not go with the replacement of this project. Okay? It's just a summation of OCF after tax and depreciation. The last one? This one? This one? It's an initial outlay. It's an initial outlay. We just put it here. It's a year zero. Initial cost.
Professor?
This shows the function of the V.
Function of? Yeah, sure. Yeah, it's being recorded. Sure. It's recorded. I'm done actually. I will stop recording it. Stop sharing it. So we have like 1, 2, 3, 4 students here. Now, guys, do you have any questions? Yes? Okay. You didn't get it. It's just a calculation of the NPV. We're using the function of NPV. It's net present value. We discount all future cash flow and subtract the investment cost. This is our discount rate, 11.5%. And this is the value we select. And plus, why plus? It's a subtraction actually. This is a negative number. And then we get this NPV calculated. Discount all your future cash flows and subtract the investment cost will give you the NPV. Okay. IRR? IRR is just a function of IRR. You just highlight all the values and it gives you the IRR. And you accept the project if IRR is greater than your discount rate. Your discount rate is 11.5, which is much higher than your IRR. That tells you not to invest in this project. Tells you not to replace the old printer with a new copier. Okay. Any questions? Maybe not now. Okay. Then I have a activity for you. Yes, please. This one?
Yes.
I added the third.
But it's not like.
In the last year, I added the terminal non-operational cash flow.
It's not 3,000.
Yeah.
I had like.
No, it cannot be. Look, add this 4,200 to.
No, the sum of total.
Yeah, total OCF.
We calculate without 5,000.
No, you should calculate with 5,400.
It was like 31.
Why 31? You added this all?
Yes.
Why you should add this all? Like total OCF means OCF after tax plus depreciation for this year. For this year is this. For this year is this. And for this year, 3 items should be added.
And what is?
23,800, it is your initial outlay, initial cost that we calculated. Okay? Okay, let me give you an activity. Do the same thing, but the only thing is changing is depreciation. Depreciation should be straight line method in here, not the macros. Do it and submit it as an activity. Activity available is on Moodle. Either you can upload your Excel file or take a picture and upload it. Do the same thing, but replace. And you know what to do? Yes, that's the only thing. And reduce the discount rate. Discount rate is 8%. Okay? Straight line method and discount rate is 8%. The new equipment should be depreciated using straight line method. Activity number 1. And you have 15 minutes. In 15 minutes, you should do it and submit it. If you do it earlier, you can go earlier. But don't go before I call you by attendance. Okay, I'm going to take the attendance. Those who are in Zoom, did you hear what to do?
Yes.
Okay, perfect. Yes.
Do the activity first or in the group?
You can discuss, you can do but don't copy and paste, please, guys. This activity is for you to understand the subject.
Because personally, I don't have the lab.
Next time, bring it.
For example, here we need to multiply to the third. Just like.
No, the problem is don't use dot, use the comma. You have a separator usually. Thank you. Aksulu, Timur, Wali Khan, Ansar, Marjan, Medina, Amirlan, not here. Anel, Asemay. Just a second, yes. Wait a second, she was first. She was first. Which one? Seven or how? Look, 4,000. 4,000 minus 0. Did you understand why 0? By formula. Everything is by formula here. Salvage value new minus salvage value of all. We don't have the salvage value of all. It's 0. It's a salvage value. Then net working capital investment we have. Tax, salvage value new minus book value new, salvage value of all minus book value of all. T is the tax. Don't speak Russian. Don't speak Russian anymore.
What was the task?
Activity, it should be the same.
The same, we have to change
Only the discount rate and the depreciation.
for how many years?
It should be straight line method, not the macros. This one we use the macros.
Macros.
Yeah, but now it should be straight line.
We don't have the salvage value, right? It equals to 0.
Whatever is you are having is here. The only is change in the discount rate and the depreciation.
Depreciation method.
Yeah.
We have to use the straight line, which is the cost of the equipment minus the salvage value.
No. Cost divided by number of years.
Number of no. So we have the 5 years. So 24,000 divided by 5, right? And we have to use depreciated. Thank you.
Yeah.
When I calculated.
It happened now, or it was before?
It was before, the first time I calculated it, but so give me something.
Did you put these dollar signs by hand?
No, but I used to use.
Sure.
Yeah.
And 24,000, how did you put? Okay. Ah, of course, here. Why you don't multiply? Okay, okay, I put them on.
Oh, thank you.
So much about exchange here, we apply straight line sheet.
No, why should it change? They didn't change. Only change, two things are changed, discount rate and that's it. It should be 8%. And you should tell what you're gonna do, replace or not replace. Don't forget to comment, guys. Don't forget to comment. Either you're gonna replace or not to replace. Yeah, problems? Okay, your discount rate is this, yeah?
Yeah, so it's.
While you-
Oh, so it's. If it's. Yeah.
Is it in Russian? No. Nice. Office update. Ah, got it. I know your problem. Well, English.
We don't, first of all, the form of depreciation is cost of the equipment minus salvage value divided by.
No, don't subtract. Why should I subtract? They subtract, no. You just divide it by number of years, that's it.
Just fine.
Because salvage value is used in here, in the terminal value. What you're saying is correct, it's in accounting. But in corporate finance, when you do this financial modeling, you use the salvage value here. We're using only in that purpose for the estimation of the depreciation, which is divided by number of the years. We don't subtract the salvage value. For accounting, it's true, but for corporate finance, no, we don't subtract.
Still 5 years left.
Yeah, 5 years. Yeah. I forgot. Just a second. Dameli, Alibek, Sabina, Jadra. Jadra here. Rasul. Laura, Daniel, Alihan, Nuray. Wait, which Nuray? Kanatova, yeah? Vasilia, Kairat,
Убеева
Right.
Нурай is here.
Beva. She is here, I can see. Aidana, Nazirke,
Here,
Nazirke, are you here?
yes,
I can see you. Diana, Kıyırbayev. Diana.
Here,
Ah, she's here, okay. Aruzhan Mukasheva. Akirke. Aruzhan Otantaeva. Okay. Aslan. Dana. Sabitova. Okay. Yerzhan. Tamiris here. Yeldana. Indi. Okay. Dilnos.
Professor,
Randolph.
could you even rise here?
Okay. Aygerin. And Ajar.
Professor, could you even rise here?
Yeah, this is the macros. Now you need to change the differentiation, make it straight line. No, straight line. 24,000 divided by 5.
Is it overrated to go to actually like make it business?
No, it's already in the.
Professor,
Ah. Do you want to
Professor.
send me the YouTube where you can convert it very easily? It's in preferences in Apple. You can do it later at home, but now, okay.
Professor, could you even rise here? Did you mention?
So, what is this? Total OCP, your total OCPs are not correct. Where's your investment cost? Look at here.